So, Andrew, let me ask you a question. Would you actually like to retire early?
Sure.
So would I. The next question that I want to ask you is that would you still be able to give me your half of the mortgage?
Well, that's a good question.
Well, Andrew, if you cannot provide me your half of the mortgage, then of course we're going to have to look elsewhere to make sure that we can cover our expenses. And that may be diving into our retirement accounts. Now, of course, if you decide to do this at the age of 55, we know about the rule of 55 allowing us to do this and avoid that 10% early withdrawal penalty. But we still will have to pay ordinary income tax on those dollars. Now, of course, we never recommend that you take money out of your retirement accounts early because we know that money should be growing on the back end. But can it also provide us with a taxable benefit when we start taking income later on from our Social Security benefits? That is the question that we're going to be answering today. So you're going to want to stay locked into this video today as we discuss a very intuitive concept of if you are going to take money out of your retirement accounts early, how it may possibly provide you with a tax benefit on the back end. Hi, my name is Carson Graves, President and CEO of the Retirement Education Center.
And my name is Andrea, Director of Operations at the Retirement Education Center. And the reason we've created these educational videos is to help to make the difficult and confusing retirement process simple.
Absolutely, Andrea, and we do this by incorporating a team of strategic partners ranging from certified financial analysts, certified financial planners, estate attorneys, insurance advisors, and other needed professionals to help us build a comprehensive and holistic roadmap that is going to let our clients know when, where, and how they can reach their retirement goals.
For specialized strategies on how to maximize your retirement income, please subscribe to our YouTube channel and hit the notification bell to be notified when we upload new videos. So Carson, what you're saying is that if I want to retire early and I can't cover my half of the expenses, you're going to be serving me with an eviction notice?
Well, Andrea, I don't know if it's going to be that drastic or not, but I will say this: you may have one less date night in your future. But with that being said, there is a rule known as the rule of 55. If you retire at the age of 55, Andrea, where you can actually retire and actually take money from your 401k or 403b and not be assessed that 10% early withdrawal penalty. Now, that is a unique rule, and if you're a public employee, you can actually do it at the age of 50. Now, many people, many advisors would not advise anyone taking money out of their retirement savings, Andrea, early if they can avoid it, because we want those dollars to be placed in those accounts and left in those accounts to grow on the back end. But with that being said, could you utilize those distributions in a very intuitive way and allow yourself to actually have more income and less taxes on the back end when you start receiving your other income from like Social Security? And so that's what we're going to cover today in our short educational video. Can the rule of 55 or taking distributions out of your retirement accounts be a unique strategy in order to reduce taxes on the back end when you start receiving your other income sources? But before we get into that, there are two rules to retirement income that we always want to give you. And Andrew, what are those two rules?
Well, rule number 1 is to never run out of money, and rule number 2 is to never forget rule number 1.
So let's go ahead and talk about the rule of 55 and reducing taxation on your Social Security benefits. So let's go ahead and talk about the rule of 55 and how it may reduce your Social Security taxes on the back end. This is going to be a very good educational video today. So just quickly, I want to recap what the rule of 55 is. So if you leave your job at the age of 55 or older, and you want to access like a 401k or a 403b before the age of 59 and a half, if you exercise the rule of 55, you can do so without actually receiving a 10% early withdrawal penalty. So if you were laid off, if you were fired, or if you just quit your job, you of course have to leave that job, your employer, in the calendar year that you turn 55 or later. You can have a penalty-free distribution from those accounts. If you are a public safety worker, like a firefighter, air traffic controller, or police officer, you can actually do this at the age of 50. One of the things to keep in mind, if you do roll over that 401k or 403b into an IRA, you no longer will have the opportunity to utilize the rule of 55. Now, we did a video, a short educational video about the rule of 55 that I would highly encourage you, if you haven't seen it already, it's a very popular video. I highly encourage you to go take a look at it to get a full insight view of what the rule of 55 is and how it may affect your retirement. So now let's go ahead and do a short recap of the taxation of your Social Security benefits. So if you've seen my other videos, we've done numerous videos on Social Security. But if you've seen my videos on the taxation of Social Security benefits, you would know that anywhere from 50% to 85% of your Social Security benefits can be taxable if your provisional income exceeds a certain base amount. So we want to take a look at that real quick. So if you're single or head of household and you're making less than $25,000 a year, you will have zero taxation on those Social Security benefits if your provisional income falls in that bracket. Now, when that provisional income exceeds, $25,000 anywhere to $34,000 a year, then that money will then be able to be taxable up to 50%. And if you earn over $34,000 a year of income, those benefits can be taxed up to 85%. If you're married filing jointly, if you're making less than $32,000 a year, zero taxation will be on those benefits. And then when you hit the $32,000 or $44,000 mark, then up to 50% of those benefits can be taxable. And anything over $44,000 a year can be taxed up to 85%. So it's really easy to see why so many Americans are taxed on their Social Security benefits, which is why you want to consult with an advisor who can help you either minimize or completely get rid of those taxation if possible. Now, we did a video, a very funny video on the taxes and your Social Security benefits, and as you can see, it was right before Thanksgiving. So if you really want to get a full insight on how your Social Security benefits are taxed as it relates to your provisional income, I encourage you to go take a look at that as well. So let's go ahead and take a look at this hypothetical example here. We're going to first take a look at Mr. I Don't Know, and we're just going to look at him being a single male right now. We're just going to look at him being single and not married filing jointly, just so you can get a concept of how the rule of 55 or taking money out of your IRA could possibly reduce your Social Security taxes on the back end. So Mr. I Don't Know retires at age 55, and he decides to use the rule of 55. Now, at the time that he retired, his 401k, hypothetically, was at $200,000. But at the age of 70, he decided to stop taking from that 401k and just start his Social Security benefits. Now, we know under the Secure Act now, he does not have to take any RMDs or required minimum distributions from that IRA until age 72. So at age 72, he will have to take from that 401k at this point. Now, at the time that he decides to, exercise those RMDs, his account had grown a little bit more. It's at $205,000 now at age 72. So here's the scenario. His Social Security benefits that he's going to be receiving is going to be $30,000 a year. And based off the RMD table factors that we've already calculated, based off of his end of year value from his 401k or IRA, he's going to have to take a little over $8,000 a year in required minimum distributions from that account. Now, so that's going to make his total income a little over $38,000. Now, the way they look at your provisional income is that they take half of your Social Security benefits. So that's going to be $15,000. But they take all of your other income sources with the exception of Roth IRAs. That's why I say go watch that video so you can understand the full concept of this. But because we're only keeping it very simple in this video, he only has IRA income or 401k income. So that's going to be calculated in that provisional income fully. And so his total provisional income is $23,000, a little over $23,000. So the percent that he would actually pay on his Social Security benefits would be zero. He would pay zero taxes on that Social Security benefits because he is under that $25,000 mark. So he's in the clear. He don't owe anything on his Social Security benefits. So let's take a look at another scenario here. We have Mrs. I Don't Know. She's going to do things a little bit differently. She's going to retire at 67, and then she's going to start taking her Social Security at her full retirement age. Now, at the time, because her 401k was allowed to grow longer, her 401k is valued at $400,000, And at the age of 72, just like Mr. I Don't Know, she's going to be required to take from her IRA or 401k her required minimum distributions at the time. Now, at the time that she's going to be taking a distribution from her 401k or IRA, her IRA or 401k is going to be valued at $510,000 because she's not touched those funds. It's just been sitting there allowed to get that tax deferred growth over the years. So here's her scenario. So she's going to be taking less Social Security benefits. She did not delay her benefits like Mr. I Don't Know to receive any type of delayed retirement credit. So she's going to be receiving $28,000 a year because her IRA is so much larger. Her RMD factors are going to be much larger. So she's going to have to take, and she cannot decide not to take this. It's going to be mandatory. She's going to have to take $19,245 in that year out of her IRA or 401k because of those factors. So her total income is going to be $47,245 for the year. So when it comes to her provisional income, they're going to take, just like Mr. I Don't Know, they're going to take half of her Social Security benefits along with her required minimum distributions of $19,245, giving her a provisional income of $33,245. So what is that going to do? That is going to push her into the percentile of having her Social Security benefits taxable up to 50%. So it's really very important that you understand this concept and why sometimes on an intuitive basis, we have our clients take money from their IRA accounts early in order to reduce that IRA down so that on the back end, when they start receiving other income, they may have a less taxable situation coming their way. Now, with that being said, no matter what your financial situation may be, you're going to always want to consult with your own financial advisor or tax advisor. With that being said, we would love to speak with you about these matters or any matters that you may have. And if you decide to speak with us, ask us how your next cup of Starbucks coffee can be on us. So I hope that this video gave you some insight on how you might utilize the Rule of 55 to help reduce taxation on your Social Security benefits on the back end. Please remember that these videos are created for educational purposes only, and that you should always seek out your own financial advisor or tax advisor for your own unique situation. Also, if you are looking for a fiduciary advisor, we will highly encourage you to apply to become our client by clicking on the link in the description below. For more information on this topic or any other topics that we've talked about in our past videos, feel free to leave any questions or comments in the section below.
To learn more about our services and how we can help you to increase your chances of not outliving your retirement savings, make sure to click on the link in the description below and sign up for our free Maximizing Your Retirement Income Masterclass. After this video, please check out our other videos that we've created that will give you tips on how to maximize your retirement. Also, if you like this video, please give it a thumbs up, subscribe to our YouTube channel, and share it with a friend. Thanks for watching, and remember, if you have questions,
we have answers.